This is game-changing. Not because someone shouted it, not because a chart flashed a pattern, not because a headline felt dramatic. It is game-changing because we are living through a structural shift in how value is measured, how risk is priced, and how trust is distributed across the financial system. And if you are a silver stacker, if you care about real assets, if you care about preserving purchasing power in a world built on leverage, then you need to slow down, breathe, and understand exactly what is unfolding. Right now, the noise is loud. You are hearing that a reopening somewhere is the spark. You are hearing that stress in the system means an imminent snap. You are hearing that a breakout confirms inevitability. You are hearing price targets thrown around like lottery numbers. And every time someone says guaranteed, your pulse speeds up just a little. But here is the first truth. Markets do not reward adrenaline. They reward discipline. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. When a major market reopens after being closed for several sessions, that does not automatically mean price explodes upward. It means participation expands, liquidity changes, dormant positions wake up, hedgers re-engage, speculators reposition, and the first hours after that reopening are less about destiny and more about discovery. Discovery of intent. Think about what really happens when liquidity returns. During a closure, price can drift on thinner participation. Moves can extend further than they would under normal depth. Sentiment can build in echo chambers. Narratives can harden. Then the doors open. Suddenly, larger pools of capital can express agreement or disagreement. That is, when you find out whether the prior move had conviction behind it or was simply an air pocket. This is critical for silver stackers to understand, because silver is not just another ticker symbol. Silver sits at the crossroads of monetary fear, industrial demand, speculative energy, and liquidity stress. It can behave like a safe haven one week and like a high beta risk asset the next. So when people say, this reopening changes everything, the correct response is, it reveals everything. Stress is another word being thrown around like a siren. Stress in a market does not automatically mean collapse. It often means imbalance. And imbalance is resolved through price, time, or structure. If near-term contracts trade at unusual spreads relative to later contracts, that is a message about urgency. If physical premiums widen, that is a message about sourcing friction. If positioning becomes crowded, that is a message about vulnerability. But vulnerability cuts both ways. If too many traders lean short, a squeeze can be violent. If too many traders lean long, a flush can be brutal. Silver has a history of both. It does not move politely. It does not trend smoothly. It lurches, it consolidates, it whipsaws, and then it explodes when least convenient for the majority. That is why this moment feels different, because the ingredients are lining up in a way that forces you to choose your mindset. Look at the macro backdrop. Global debt levels are enormous. Refinancing cycles are constant. Governments face trade-offs between stability and purchasing power. Policy responses over the past decade have shown a clear bias towards supporting markets during stress. That bias matters. It creates an undercurrent beneath hard assets, not because they spike overnight, but because over time, policies that prioritize system stability tend to dilute currency strength. Silver lives inside that tension. It is not only a monetary metal, it is embedded in the industrial grid. Conductivity, electronics, energy infrastructure, emerging technologies. Silver has roles that are not easily dismissed. As investment cycles rotate toward infrastructure and technological build-out, industrial demand narratives gain weight. But demand alone does not dictate price. Supply matters. Substitution matters. Efficiency improvements matter. Above all, capital flows matter. A true game-changing move requires capital flow alignment. Monetary fear, industrial demand, and speculative momentum must lean in the same direction at the same time. That alignment does not happen every month. When it does happen, it tends to surprise people who are waiting for perfect clarity. Right now, uncertainty is thick. Trade tensions, tariff debates, geopolitical friction, these inject instability into forecasting models. When forecasting becomes difficult, hedging becomes attractive. Gold often benefits first because it is the primary monetary hedge. Silver often lags, then accelerates when momentum shifts from caution to conviction. That acceleration is what silver stackers dream about. The catch-up phase, the moment when the gold-silver relationship compresses and silver outpaces expectations. But here is the uncomfortable truth. Catch-up phases rarely begin when the crowd is fully prepared for them. They begin when positioning is offside. They begin when complacency or disbelief dominates. They begin when a catalyst forces repricing faster than supply can respond. So ask yourself, is this one of those moments? Or is this a test? Charts are showing compression resolving. Breakouts are being discussed. Momentum indicators are curling upward. Long-term trend lines are being respected. These are constructive signals. But signals are not guarantees. A breakout that fails can trap aggressive buyers. A breakout that holds can force reluctant buyers to chase. The difference is follow-through. In real time, follow-through reveals itself in how price behaves after the initial surge. Do pullbacks attract buyers quickly? Does volume expand on advances and contract on declines? Does volatility compress after expansion, signaling acceptance? Or does volatility expand in both directions, signaling confusion? Silver stackers who understand this do not panic on the first red candle. They watch structure. They watch behavior. They understand that the strongest trends often begin with shakeouts that scare away weak hands. Another layer to this moment is psychology. Social media amplifies urgency. Price targets are thrown around with dramatic precision. 3 digits, 4 digits. Exponential projections based on historical analogies. Analogies can be useful, but history rhymes. It does not copy. Past cycles feature different debt levels, different technological backdrops, different geopolitical alignments, different regulatory environments. The pattern may echo, the magnitude may differ, the timing almost certainly will. That does not mean silver cannot experience a powerful revaluation. It means that patience and risk management separate those who benefit from those who burn out. There is also the perennial debate, paper versus physical. Futures markets influence price discovery. Large players can move markets during thin liquidity windows. Physical demand can create tightness in supply chains. All of this can be true simultaneously. But believing that structural pressure translates into immediate price eruption is a mistake. Structural pressure builds like tectonic stress. It accumulates. It releases in bursts. Between bursts, there can be long periods of frustration. Silver stackers who view their holdings as long-term insurance are less vulnerable to short-term volatility. Those who treat every headline as a countdown clock are more vulnerable to emotional decisions. This is why defining your game is essential. Are you trading the next few sessions, or are you allocating for the next few years? The tactics differ radically. A trader may need tight risk parameters and rapid reassessment. A long-term stacker needs conviction grounded in macro reasoning and personal financial discipline. Mixing those approaches leads to confusion. Buying with long-term intent and then selling on short-term fear is a costly cycle. The current environment presents both opportunity and risk. If liquidity returns and confirms demand strength, silver could accelerate. If liquidity returns and reveals crowded positioning, a sharp dip could precede any sustained move. Either scenario can occur within days of each other. Game-changing does not mean straight line. It means structural shift. Structural shifts unfold through volatility. They test conviction. They expose overconfidence. They reward preparation. As a silver stacker, your advantage is optionality. Physical holdings are not subject to margin calls. They do not require rollover. They are not dependent on counterparty solvency in the same way leveraged instruments are. That optionality allows you to think beyond intraday noise. However, optionality is wasted if emotion drives your decisions. So what should you focus on? First, watch how silver behaves relative to gold. If gold remains firm while broader risk assets wobble, it signals defensive capital flow. If silver begins to outperform gold in that environment, it suggests a shift from defensive hedging towards speculative momentum layered on top of monetary concern. That alignment can be powerful. Second, observe how quickly dips are bought. Fast rejection of lower prices indicates underlying demand. Slow, grinding declines with weak bounces suggest distribution. Third, monitor volatility. Explosive volatility, followed by tight consolidation, often precedes continuation. Explosive volatility, followed by chaotic whipsaw, often precedes deeper retracement. Fourth, remain aware of liquidity cycles. When funding markets tighten, even strong assets can be sold temporarily to raise cash. That does not invalidate long-term theses. It creates entry opportunities for those prepared. Game-changing moments feel uncomfortable in real time. They do not arrive with perfect clarity. They arrive with disagreement. Some call them fake-outs. Some call them the beginning of something historic. The truth only becomes obvious later. Right now, the ingredients for a significant move exist: debt overhang, policy flexibility, technological build-out, geopolitical tension, market compression, reopening liquidity. But ingredients alone do not bake the cake. Heat and timing matter. Heat comes from capital flows. Timing comes from catalysts. Catalysts can be policy shifts, unexpected data, geopolitical escalation, or simply the collective realization that a range has held long enough. If you are waiting for unanimous confirmation, you will miss the early phase. If you are chasing every rumor, you will exhaust yourself before the phase begins. Silver has a history of humbling both extremes. The calm stacker survives volatility because their thesis does not hinge on daily affirmation. The impatient speculator often sells the bottom and buys the top because urgency overrides planning. So as this week unfolds, treat each session as information gathering. Not prophecy fulfillment, not fear validation. Information. If price surges and holds, ask why. If price surges and fails, ask why. If price drifts sideways, ask what energy is building beneath the surface. Game-changing does not mean tomorrow morning at the open. It means the landscape is shifting in ways that increase the probability of larger revaluations over time. Your role is not to predict the exact hour. Your role is to position intelligently within the shift. And that begins with discipline, not excitement. Now let us go deeper, because understanding surface mechanics is not enough if you want to navigate what could become one of the most consequential cycles for silver in decades. When monetary systems stretch, they rarely snap cleanly. They bend, they adapt, they reprice gradually. The revaluation of hard assets tends to occur in waves: a surge, a consolidation, a retracement, another surge. Each wave shakes out a different group of participants. In early waves, believers accumulate. In middle waves, skeptics convert. In late waves, momentum chasers flood in. The final wave is often the most dramatic and the most dangerous. Silver's historical behavior reflects this psychology. Extended dormancy builds frustration. Breakouts ignite hope. Sharp corrections breed doubt. Then, acceleration returns with greater force. If we are entering a new structural phase, the early signals will not look like euphoria. They will look like tension. Tension between inflation and growth. Tension between currency strength and fiscal expansion. Tension between industrial demand and supply constraints. Tension between leveraged positions and physical ownership. As these tensions resolve, price becomes the scoreboard. Consider the role of real interest rates. When real yields are deeply positive, holding non-yielding assets appears less attractive. When real yields compress or turn negative, the opportunity cost of holding silver decreases. Policy cycles influence this dynamic. If growth slows while inflation remains persistent, real yields can compress rapidly. That environment historically supports precious metals. But again, timing is nonlinear. Markets anticipate. They overshoot. They correct. Another dimension is currency confidence. When reserve currencies maintain credibility, capital seeks yield and productivity. When confidence wavers, capital seeks preservation. Silver benefits most when preservation demand intersects with speculative enthusiasm. That intersection is rare, but powerful. Now layer in industrial transformation, electrification, grid modernization, renewable infrastructure, advanced electronics. These are not abstract trends. They require materials. If investment in these sectors accelerates over years, baseline demand for conductive metals increases. If supply growth lags due to underinvestment or geological limits, price pressure builds. However, supply response is complex. Mining projects require time, capital, permitting, and political stability. When prices rise, exploration increases. When prices fall, investment contracts. This boom-bust cycle creates lag effects. By the time new supply comes online, demand dynamics may have shifted. Therefore, structural deficits can persist longer than expected, or resolve faster than anticipated. Silver stackers who view the metal solely through a monetary lens may underestimate industrial influences. Those who view it solely through an industrial lens may underestimate monetary catalysts. The real story often lies at the intersection. Volatility, which many fear, is actually the mechanism by which markets discover new equilibrium. Without volatility, there is no repricing. Without repricing, structural shifts remain hidden. If silver begins to trend with expanding volatility to the upside, that signals expanding participation. If volatility expands downward but quickly compresses, that signals absorption. Absorption precedes continuation more often than not. You must also respect liquidity risk. In moments of acute stress, even fundamentally strong assets can be sold. This is not ideological, it is mechanical. Leveraged portfolios sell what they can to meet obligations. That selling can create temporary mispricing. For prepared stackers, mispricing is opportunity. But preparation requires liquidity on your side. It requires that you do not deploy all capital at once based on emotion. Staggered accumulation, predefined allocation, and risk tolerance awareness are not glamorous, but they are effective. Let us address the idea of a crack in the system. Many anticipate a singular event that unleashes suppressed value overnight. Reality is often more subtle. Systems evolve, rules adjust, liquidity facilities expand quietly, regulatory frameworks shift. Over time, these incremental changes alter incentives. Hard assets respond not only to crisis but to policy drift. Policy drift is less visible than crisis, but equally important. If policymakers consistently choose short-term stability over long-term currency strength, the compounding effect erodes purchasing power. Silver, as a tangible asset, reflects that erosion over time. The game-changing aspect of this moment may not be a vertical spike tomorrow. It may be the recognition that the macro path favors tangible assets structurally. Recognition spreads gradually. At first, only a minority allocates meaningfully. Then, institutions adjust portfolios incrementally. Then, narratives shift in mainstream discourse. By the time broad consensus forms, much of the repricing has occurred. As a silver stacker, your advantage is early conviction paired with patience. But conviction must be informed, not blind. Ask yourself, if silver drops sharply before rising, will you view that as thesis invalidation or structural volatility? Your answer determines whether you benefit from the cycle or become discouraged by it. Game-changing environments reward those who can zoom out. Zooming out does not mean ignoring short-term signals. It means placing them in context. If a reopening triggers choppy trading, that is normal. If a breakout retests support, that is normal. If social sentiment swings wildly between euphoria and despair within days, that is normal. What is not normal is a global system with elevated debt, persistent geopolitical friction, accelerating technological transformation, and policy flexibility converging simultaneously. That convergence increases tail risk. Tail risk increases demand for hedges. Hedges include precious metals. Silver, because of its dual nature, can outperform when both hedging demand and growth optimism align. That alignment is rare, but explosive. Consider the gold-silver relationship as a barometer. When the ratio is elevated, silver is historically undervalued relative to gold. When the ratio compresses rapidly, silver is outperforming. Sustained compression often accompanies strong bull phases in silver. But ratios can remain extended longer than expected. Patience is required. Now let us talk about emotional endurance. Holding silver through multi-year consolidation is not easy. Watching other assets outperform can create doubt. Hearing constant predictions of imminent breakout that fail can create fatigue. Fatigue leads to capitulation. Capitulation often precedes breakout. Markets have a cruel sense of timing. They test conviction right before rewarding it. If this cycle is indeed game-changing, it will test participants first. It will create pullbacks that seem unjustified. It will create headlines that appear bearish. It will create volatility that shakes confidence. The disciplined stacker expects this. They do not require constant validation. They understand that volatility is tuition for asymmetric potential. But discipline does not mean recklessness. It means clarity. Clarity about allocation size. Clarity about time horizon. Clarity about risk tolerance. Clarity about personal financial stability. Silver should not represent desperation. It should represent strategy. When strategy replaces desperation, volatility becomes manageable. Let us imagine two scenarios. In the first, liquidity returns, silver breaks higher with strong follow-through, gold remains firm, and macro uncertainty persists. Momentum builds, industrial narratives gain traction, institutional flows increase gradually. Price stair-steps higher with periodic corrections. Over months, the trend becomes undeniable. In the second scenario, liquidity returns, silver spikes briefly, then retraces sharply as crowded positions unwind. Sentiment flips negative. Doubt spreads. Price consolidates for longer than expected. Meanwhile, macro conditions continue to deteriorate quietly. Then, at a later catalyst, silver launches from a stronger base with fewer weak hands. Both scenarios can lead to substantial appreciation over time. The difference is emotional path. If you can withstand the emotional path, you can participate in the outcome. Game-changing does not guarantee comfort. It guarantees movement. And movement creates opportunity for those prepared. Your preparation is not just financial. It is psychological. You must be able to watch price move against you temporarily, without abandoning reason. You must be able to watch price move in your favor, without becoming euphoric and overextending. You must recognize that markets oscillate between underpricing and overpricing narratives. Silver's narrative has oscillated for years between irrelevance and inevitability. Perhaps the shift now is toward inevitability, but inevitability unfolds in stages. If the macro environment continues to favor tangible assets, Silver's stage may be approaching. But whether that stage begins this week or later is less important than whether you are positioned responsibly. Game-changing moments reward foresight more than speed. Speed without foresight is gambling. Foresight without speed is missed opportunity. Balance the two. As this cycle develops, watch for sustained higher lows on larger timeframes. Watch for increasing institutional commentary acknowledging allocation. Watch for persistent strength despite negative headlines. Watch for the gold-silver relationship tightening over months, not days. These are structural signals. They matter more than single-session fireworks. And remember, silver does not need universal agreement to move. It needs incremental capital shifts. Incremental shifts compound. Compounding creates revaluation. Revaluation feels sudden when viewed from the end. From the beginning, it feels uncertain. We are in uncertainty. Uncertainty is fertile ground. So this is game-changing not because someone promised instant riches, not because a single session will define destiny, but because the structural forces beneath the surface are aligning in ways that favor tangible value over fragile promises. As a silver stacker, your edge is patience, discipline, and clarity. Let volatility inform you, not intimidate you. Let macro reality guide you, not viral urgency. If you prepare your mindset as carefully as you build your stack, you will not need to chase the move. You will already be positioned for it.